Candlestick patterns. You've seen them everywhere, right? From flashy trading courses promising master these 5 candles and triple your account, to influencers showing perfect charts on YouTube, everyone treats them like gospel. But what if I told you most of what you've been taught about candlestick patterns is misleading? That the charts you stare at every day are not showing you truth, but a story carefully designed to make you react, not think. Every textbook says a hammer signals a reversal, a doji signals indecision, an engulfing candle signals a major shift. Millions of traders treat these like laws of nature. Yet if candlesticks were really that predictable, why do so many setups fail? Why do traders end up trapped, stop losses hit, accounts wiped, while those perfect patterns seem to only work for a select few insiders? The answer is hidden in how markets are actually structured. And it's not in the candles themselves. Imagine this. You spot a bullish engulfing candle at support. Your heart races. Finally, a reversal, you think, and you enter the trade. The next candle crushes you down. Or a doji forms at resistance. You think the market will reverse, but it keeps climbing. Frustrating, right? That frustration isn't random, it's deliberate. Candlestick patterns fail not because they're inherently weak, but because traders interpret them in isolation, ignoring context, ignoring order flow, and ignoring who is actually moving the market. Candlesticks are footprints in the sand. They show what happened, not why it happened, and certainly not what will happen next. Take a simple hammer candle. You see it at the bottom of a swing. Textbooks scream reversal. But what they don't tell you is that volume, prior price action, and liquidity context are what actually matter. Was the hammer formed during quiet accumulation or on a spike created by an algorithm dumping shares into retail orders? Without context, it's meaningless. It's just a shape. And when retail traders chase shapes without seeing the bigger picture, they become liquidity for the ones who already know the story. Patterns like head and shoulders, triple tops, morning stars, perfect on historical charts, yet live trading often crushes your expectations. Patterns work in hindsight because the story has already played out. Live markets are a battlefield, and the smart money doesn't care about textbook patterns. They care about liquidity, psychology, and timing. They design price action to trap those who blindly rely on patterns. Let me give you a real example. Tesla in late 2021. Retail traders saw a textbook double bottom forming. Everyone piled in. But the volume revealed a different story. Institutional holders were quietly selling into that demand. The pattern looked perfect, but the setup was a trap. The next few candles crushed anyone chasing blindly. The candle didn't fail. The trader's interpretation did. Candlestick patterns can be useful, yes, but only if you understand the story behind the candle. Look at the size relative to prior swings. The shadows, long upper wicks often indicate absorption at resistance, not weakness in price. Small bodies after big moves often signal indecision or distribution. Combine this with volume and context. A bullish engulfing on low volume is not strength. A doji on high volume may actually be distribution. Never trade a single candle alone. Observe clusters, prior support and resistance zones, and how price reacts around them. Candlesticks are signals, not confirmations. They're pieces of a puzzle. The full picture includes market structure, liquidity zones, and order flow. Professionals read them in this way, seeing clues instead of predictions. Patterns that seem predictive often occur randomly. Backtesting may show high success rates, but that doesn't account for manipulation, news events, or hidden liquidity. Trading isn't a classroom exercise. Every textbook pattern can be invalidated by bigger players in the live market. Crypto offers a stark example. Bitcoin and Ethereum form classic reversal candles all the time, yet the next candle sometimes wipes out days of gains. Why? Because whales accumulate or exit positions quietly. Candlestick patterns only show where retail reacts, not where the market is being controlled. The real edge comes from observing what's behind the candle, who is buying, who is selling, and why. Here's how you can approach candlestick patterns properly. Treat every candle as a clue, not a prophecy. Check if the candle coincides with volume spikes, liquidity tests, or breakout attempts. Watch prior market structure. Ask yourself, who benefits if I trade this pattern? Most often, the answer is not you. Combine candlestick reading with order flow or footprint charts if your platform allows it. See where large trades occur, whether textbook patterns coincide with real buying or selling pressure. Patterns themselves are neutral. A hammer at support on quiet accumulation is useful. The same hammer during high retail panic is a trap. A doji at resistance can signal exhaustion or be a setup for smart money to dump. Interpretation and context are everything. Multi-candle patterns like head and shoulders, triangles, or morning stars look perfect historically, but in real time, they rarely behave as expected. Instead of memorizing names, focus on what each candle represents psychologically. Observe the battle between buyers and sellers, absorption, exhaustion, and manipulation. That's where the real edge lies. Think about it further. Every candle is a story. Long green candles may seem like strength, but sometimes they're simply retail chasing a move that smart money has already finished building. Long red candles may seem like weakness, but in some cases, they're absorption, the big players taking the other side quietly before the next push. Understanding the psychology behind each candle is what separates amateurs from professionals. Even common patterns like morning stars or shooting stars are tricky. They're not predictive magic. They're the market's storytelling tools. Every textbook pattern you memorize has been observed, back-tested, and then exploited by the very players who design price action. The moment a majority of traders rely on a pattern blindly, it loses effectiveness. The market anticipates your behavior, not the pattern itself. Volume is another critical layer. A candlestick alone without volume context is just a snapshot. High-volume green candles at support may indicate real accumulation. High-volume green candles at a resistance zone, that's distribution disguised as a bullish move. Professionals always check the size of the move relative to volume and context, not just the candle's shape. Let's bring in a practical example. Imagine a stock consolidating for 15 days. On day 16, a hammer appears at the bottom. You jump in, but the volume tells a story. Low participation, no follow-through. Smart money has been quietly selling into retail demand during this move. By the time the public notices a bullish engulfing on higher volume, the insiders have already exited. The textbook signal was there, but the context betrayed the trader. That's why interpretation matters more than the pattern itself. Candlestick patterns also interact with news events, options expiry, and algorithmic triggers. A shooting star appearing just before options expiry might trigger retail stop hunts, causing a rapid price movement. Historical pattern books won't teach you that. Observing how candles react to real-world market triggers is the skill professionals develop over years. And this isn't limited to stocks. Crypto, forex, commodities, everywhere you go, the same principles apply. Candlestick patterns reveal reactions, not intentions. They show where traders react, where liquidity exists, and sometimes where traps are set. By the time the textbook pattern completes, the smart money has already acted. So how should you trade patterns? Begin by treating them as tools for observation, not execution. Look at clusters, volume, context, and who benefits from the move. Analyze multiple timeframes to confirm that the move has real conviction behind it. Ask yourself, is this candle part of accumulation, distribution, or manipulation? Once you start thinking this way, your perspective shifts from reactive to strategic. Keep a trading journal. Note every candlestick you see, the context, volume, and the outcome. Over time, patterns will start making sense in context, and you'll realize that the market isn't random. It's a story being told, and each candle is a word in that story. Professionals read that story. Retail traders read shapes. By now, you may be thinking this is complicated. And yes, it is. But that's the point. Candlestick patterns are not simple tools. They're part of a complex communication system between market participants. If you want to survive and thrive, you need to see beyond the shape, beyond the textbook definition, and understand the psychology, the context, and the manipulation hidden behind each candle. Next time you see a hammer, a doji, or a shooting star, don't react immediately. Pause. Observe. Ask who benefits from the move. Check the volume, the order flow, and the market structure around it. Look at the bigger picture before assuming the textbook pattern guarantees anything. That's how you start trading like a professional, rather than just following shapes on a chart. And if this video opened your eyes even a little, subscribe, hit the like button, and check out my other videos where we break down real-life chart traps, smart money techniques, and hidden market manipulation in live action. Candlestick patterns are just the beginning. The market's secrets are deeper, and the truth is far more revealing than any pattern could ever be.